The rest of Asia is rallying to record highs. Indonesia has fallen to a 5-year low. This divergence is not bad luck. It is a verdict. Act 1. The spark. How does a nation that spent nearly 3 decades rebuilding its economic credibility lose the trust of global markets in less than 6 months? For most of the last 20 years, Southeast Asia's largest economy was the reliable darling of emerging market funds. A predictable, massive growth story powered by 270 million consumers and an insatiable global appetite for natural resources. But as the rest of Asia climbs, Indonesia is enduring a brutal, lonely sell-off. The Jakarta Composite Index has tumbled approximately 32% in 2026, making it the worst-performing equity index among more than 90 tracked globally by Bloomberg. The Rupiah tells the same story. It has shed more than 14% of its value since President Prabowo Subianto took office in October 2024. On June 3, 2026, the currency weakened to a record low of 17,950 per US dollar. That number carries real weight. The currency of Southeast Asia's largest economy is now worth less against the greenback than it was during the absolute nadir of the 1997 to 98 Asian financial crisis. To feel what these numbers actually mean, step away from the trading terminals and walk into a Warung, a family-run food stall in the packed alleyways of South Jakarta. A small business owner named Sari has spent the last 3 months watching her operating costs climb. She does not own an equity portfolio. She does not check Bloomberg for the daily exchange rate. But she feels the pressure of 17,950 rupiah per dollar every single morning. She feels it when she pays for cooking gas, which has risen steadily for 90 days. She feels it in the increased delivery fees charged by the motorcycle riders who bring fresh ingredients to her store. And she feels it when regular customers opt for smaller portions because their own salaries no longer stretch as far. In an economy deeply exposed to imported energy, every rupiah drop acts as an invisible regressive tax on daily life. Consumer prices in May 2026 rose 3.08%, climbing above Bank Indonesia's midpoint target and hitting household wallets across the archipelago. This is not a story of global macro contagion. International fund managers are clear. This crisis has made in Jakarta stamped across it. Global funds have withdrawn more than 3.2 billion US dollars from Indonesian equities in 2026 alone. The capital flight is so severe that Indonesia has ceded its 5-year title as Southeast Asia's largest stock market to Singapore. That is a profound shift in how capital is allocated across the region. International investors are no longer viewing this as unavoidable emerging market volatility. They are treating it as a localized, self-inflicted risk. Act 2. The foundation. To understand why global capital has reacted with such severity, you need to understand the historical shadow hanging over this administration. In the late 1990s, the collapse of the rupiah did more than destroy banks. It tore down a 3-decade political regime, forcing President Prabowo's former father-in-law Suharto from office amid widespread social upheaval. The modern Indonesian state spent 30 years building institutional safeguards to ensure that history would never repeat itself. Under Presidents Susilo Bambang Yudhoyono and Joko Widodo, Jakarta established rigid fiscal discipline, central bank independence, and predictable market transparency. These were not just bureaucratic achievements. They were the precise guarantees required by global pension funds and sovereign wealth managers to invest in a young democracy. When President Prabowo took office, international markets did not panic immediately, but they began watching with heightened vigilance. Investors held quiet, persistent concerns that the new administration's ambitious domestic spending plans and centralized governance style might slowly unwind the fiscal guardrails that took decades to build. In global finance, historical memory is long. Policy signals are read through the harsh lens of past crises. The institutional credibility that took 30 years to earn can be compromised in weeks if asset managers suspect a return to top-down, opaque economic management. The current capital flight did not happen all at once. It arrived in 4 distinct compounding pressure waves across the first half of 2026. Act 3. The money question. The first shock arrived in January 2026. Morgan Stanley Capital International, or MSCI, issued an explicit warning that it might downgrade Indonesia from its emerging market index to frontier market status. The index provider cited a serious lack of transparency regarding corporate ownership and market liquidity. The announcement triggered immediate panic. The resulting market rout wiped out approximately 120 billion US dollars in equity value within days. The fallout forced the abrupt departures of both the chief executive of the Indonesian Stock Exchange and the chairperson of the Financial Services Authority. For ordinary Indonesians with retirement savings tied to domestic funds, those exits were not just headlines. They were signals that the people who were supposed to protect the market had lost the confidence of the institutions that made it move. The second wave hit the nation's debt architecture between February and March 2026. Within weeks of each other, two of the big three global rating agencies shifted their stances. Moody's downgraded Indonesia's sovereign debt outlook to negative. Fitch followed, revising its own outlook from stable to negative. For pension boards and macro funds, these dual revisions were a bright red signal. Borrowing costs rose just as regional neighbors enjoyed stable inflows. Act 4. The consequence chain. The structural isolation deepened in May. During MSCI's semi-annual index rebalancing, 19 Indonesian companies were removed from its global standard and small cap categories. Not a single new local enterprise was added. This was not a minor portfolio adjustment. It was an institutional verdict on the transparency and liquidity of corporate Indonesia. Then, while the market was still absorbing that blow, the fourth and most disruptive wave landed. President Prabowo announced that effective June 1st, 2026, the state would assume direct control over the exports of Indonesia's most vital commodities, palm oil, thermal coal, and nickel. All outbound trade for these sectors would be executed exclusively through a government-appointed state exporter under the newly formed sovereign wealth fund, Danantara. The administration framed this as a strategic move to maximize domestic revenue. International capital read it as a severe interventionist shock. By taking direct control of the country's most lucrative commodity revenues, the state disrupted the cash flow predictability of private and foreign-listed joint ventures. For global funds already spooked by governance concerns, this was the final trigger to accelerate their exit from Jakarta. The mechanics of a modern market exit are cold and mathematical. When MSCI reduces an emerging economy's structural weight or threatens a frontier market downgrade, it triggers an algorithmic domino effect. Global passive funds, index tracking exchange-traded funds, and large Western pension mandates are legally required by their prospectuses to align their holdings precisely with these indices. They do not pause to evaluate individual company fundamentals. They sell automatically at volume by default. Act 5. The deeper implication. Indonesia is now dangerously close to a threshold where a formal frontier market downgrade would trigger mandatory institutional selling that would completely dwarf the $3.2 billion withdrawn so far this year. This self-inflicted liquidity drain is colliding with a punishing external vulnerability that has become a recurring thread across this series: the ongoing shipping crisis in the Strait of Hormuz. As covered in previous episodes, the prolonged disruption of Middle Eastern shipping lanes has sent global crude oil prices soaring. Because Indonesia transitioned into a net oil importer years ago, its fiscal balance sheet is uniquely exposed to international energy spikes. The country's vital trade surplus, which had provided an economic cushion for years, nearly vanished in April 2026 as soaring import costs overwhelmed export earnings. Bank Indonesia's foreign exchange reserves have slid toward a near two-year low. The macro strain flows directly down the chain. The exact same energy shock that has squeezed long-tail boat operators in Phuket and inflated diesel costs for factory managers across Vietnam is now working through the Indonesian economy. But while Hanoi and Bangkok are navigating this as an external trade challenge, Jakarta must fight it with a significantly weakened currency. Because the Rupiah has breached historical lows, every barrel of imported crude costs substantially more in local currency terms than it does for regional peers. The domestic economy is caught in a tight fiscal vice. What global investors are unwinding is not just their positions in Indonesian blue-chip stocks. They are unwinding their belief in the broader, multi-decade Indonesian growth narrative. For 30 years, that narrative was compelling. A stable democracy of 270 million people, an expanding middle class, immense mineral wealth essential for the global green transition, and a disciplined approach to public debt. That story attracted enormous foreign direct investment and portfolio capital. It remains a powerful thesis, but it is currently colliding with an administrative philosophy that favors state-directed control over market-driven predictability. This marks a critical turning point in what we have been tracing across this series. In our earlier look at Indonesia's $908 billion commodity wealth question, we noted that holding valuable natural resources is only half the battle. The far more critical variable is whether a developing economy can build the transparent, predictable institutional frameworks required to translate those underground resources into permanent, domestic wealth. Right now, global capital markets are signaling that Indonesia's institutional scaffolding is under severe stress. This stress test extends far beyond the Java Sea. Across Southeast Asia, large developing economies, Malaysia, the Philippines, Vietnam, are watching Jakarta's divergence with quiet anxiety. Each faces its own version of the same fundamental question: Have they built sufficient institutional depth and regulatory independence to withstand shifting political winds, or are their economic models still vulnerable to sudden centralized interventions? Indonesia has navigated severe financial crises before, but its post-1998 recovery required a decade of painful, transparent institutional reform. The critical question left open by the current sell-off is whether the Prabowo administration is willing to re-embrace that level of regulatory discipline, or whether it will continue down the path of state-directed insulation. The market has already delivered its initial verdict. The longer Jakarta takes to respond with clear, predictable policy corrections, the further regional capital will migrate toward more predictable shores. I am Hero the Hornbill, and this is the ASEAN Angle. If this episode gave you a new way of seeing the region, subscribe so you do not miss the next one. New episodes weekly. Link in the description.